Welcome to our presentation on liability management. I'm John Berkery. I'm in the Corporate and Securities Group here at Mayer Brown in New York. I'm joined by my colleagues, John Ablan, who's also in the Corporate and Securities Group in Chicago, as well as Remmelt Reigersman and our tax group based in San Francisco. So for the agenda today, we're going to start off with an overview of liability management, discussing what it is and what its benefits are. And then we're going to go through each of the different types of liability management transactions, which are set forth here, including redemptions, repurchases, debt tender offers, exchange offers, and consent solicitations. Next slide, please. Next slide, please. So what is liability management? Well, it is a term to refer to a series of transactions which are designed to assist issuers in managing, modifying, and optimizing their outstanding debt portfolio. And they do that by achieving one of the three goals here that's in the Olympic rings here to the right, them being the goal of retirement, to refinance debt, or modify debt. Now, a liability transaction may achieve all three of these goals, but every single liability management transaction will achieve at least one of them. And within each of these rings are the different types of liability management transaction that achieves the respective goal. So if you're retiring debt, you're going to be thinking about redemptions, repurchases, or cash tender offers. If you want to refinance debt, you're going to be thinking about exchange offers or a cash tender offer coupled with a simultaneous new debt issuance, I should say. And then finally, if you want to modify debt, you're going to be thinking about consent solicitation. Next slide, please. So why is liability management important? Well, quite simply, it is because of the benefits that can be achieved, many of which are set forth here on this slide 5, including first and foremost, deleveraging or reducing an issuer's outstanding debt portfolio, which is always a good thing. Reducing interest expense. That is achieved by either the principal amount of the debt portfolio being reduced or by swapping out higher coupon debt with lower coupon debt. Capturing positive economics. A company may be awash in cash. Its operating results have been, quite positive for a while, and maybe a good use of that cash is to put it towards a liability management transaction, possibly delevering. Or maybe its stock recently has been doing very well in the market, and it either wants to do a debt for equity swap exchange, or it wants to do a stock offering and use that cash from the offering to possibly delever. You can use liability management transactions to extend maturities and spread them out. If you are repurchasing debt at a discount, you may be able to record an accounting gain. And all of these things that I just mentioned can have a very positive impact on EPS, the income statement, the balance sheet, the cash flow statement. You may also be able to achieve a benefit in your ratings. So when you're doing liability management transactions, it's worthwhile touching base with the rating agencies to see if you can maximize what you're doing, the changes you're making to make sure you get the most ratings benefit. If you are a regulated entity, liability management transactions can be useful in managing your regulatory capital. If you need covenant flexibility or relief, obviously consent solicitations can be used to achieve that. But overall, just as a general statement, liability management transactions are designed to help management or a company manages capital structure on a proactive basis when it's early in the process and it has the most options available to it, rather than waiting to the last minute when the company gets in distress and maybe its only options left are a fundamental bankruptcy, a fundamental restructuring, or a potential bankruptcy. Next slide, please. So how to affect liability management transactions? Well, it depends. If cash is available at the issuer, you could think about redemptions, which is the contractual right of the issuer to repurchase its outstanding debt securities in accordance with their terms. You can think about debt repurchases or cash tender offers. Next slide, please. If you don't have cash, then issuers are going to be thinking about exchange offers, where the issuer is offering its own debt securities for its or newly issued debt securities for its outstanding debt securities. Remember, in addition to being tender offers, exchange offers are securities offerings. So therefore, you want to make sure the securities offering or the exchange offer itself is either one of two things, either registered under the 33 Act or it is done pursuant to a valid exemption. So you may be doing an exchange offer as a 4A2 private placement, or you may be doing it to QIBs, qualified institutional buyers, under Rule 144A, or non-US persons under Reg S. Another exemption is under Section 3A9, which we'll talk a little bit about later on. It's a specific exemption under Section 3 of the Securities Act for not requiring registration under the 33 Act. And then finally, consent solicitations, which is under non-cash alternatives. It's not entirely non-cash. To incentivize holders to consent to the amendments you're looking for, you do have to provide them some kind of carrot, and that's the consent fee. But in the grand scheme of things, it's not that much money, which is why it's under non-cash alternatives. Next slide, please. Choosing amongst the alternatives. Okay, so first and foremost, you have to understand the issuer's objectives. If the issuer's main objective is to delever, you're going to be thinking about redemptions, repurchases, and cash tender offers. Extending maturities or reducing interest expense, you're going to be thinking about exchange offers, and obviously with covenant flexibility, you're going to be thinking about consent solicitations, which may or may not be coupled with an exchange offer or a tender offer. It also depends upon the issuer's financial condition. As I said, there are some cash alternatives and some non-cash alternatives. And if the issuer doesn't have cash, then he's going to be primarily looking at the non-cash alternatives. There are also practical constraints. What kind of timing does the issuer have? Do they have the luxury of planning things out and time is on their side, or do they have to get things done rather quickly because they waited too long? You have to think about that depending upon which liability management transaction will fit within their respective timing. You have to think about the number of holders of the debt, the legal and contractual requirements of the transaction. All of those have to be factored in, as well as the accounting impact of the transaction, any ratings benefits to be achieved, any tax ramifications, and any impacts on regulatory capital. All of those need to be factored into the choice. Next slide, please. Thinking ahead real quickly, you just don't want to have tunnel vision and focus on your own transaction, but you have to think whether the transaction you're thinking about will comply with the issuer's other debt agreements. For instance, if you're repaying subordinated debt, generally the debt agreements that the issuer may have that are senior debt may have something to say about that. In fact, possibly prohibit it altogether. But even with respect to other, if you're taking out senior debt or repaying it, other senior debt agreements of the issuer may also restrict that. They permit it, but generally it is not uncommon for those types of agreements to say, that's fine, you want to repay other senior debt, but you're going to repay us at the same time pro rata. So you always want to factor that in. And obviously, if you're issuing new debt, you want to make sure the terms of the new debt comply with the other issuer's other debt agreements. Next slide, please. So let's take the first liability management transaction, redemptions, which, as I said before, is the contractual right of the issuer to repurchase its outstanding debt securities in accordance with their express terms. If the issuer chooses to redeem the securities, that is going to happen regardless of whether or not the holders of those securities want it to happen. Now, not all securities have redemption provisions. That's called having full call protection. They're just not redeemable, okay? What is more common is securities generally have limited call protection, which means a few years after their issuance, they are not subject to redemption, but after a certain period of time called the non-call period, they are redeemable, okay? And some securities have no call protection at all, which means they can be callable day one after issuance. In terms of difficulty, redemptions are on the easier end of the liability management spectrum. It generally just entails of the issuance of a notice of redemption. In terms of expense, it depends on when you're redeeming them. In the early years after a debt security is issued, it can be very expensive due to the redemption premium. but it may not be that expensive as the securities get closer to their maturity. In terms of timing, it all depends on the terms of the indenture. It is very common for the notice period to be at least 30 days, so that can be quite a long time compared to some liability management transactions. But I've seen it as short as 10 to 15 days. Next slide, please. So in order to affect a redemption, you just need to follow the procedures that are in the indenture or the debt agreement that governs the debt securities, which generally entails, as I said, issuing a notice of redemption. The notice of redemption would have the information that the issuer, the holders need to understand for the redemption, including the redemption price, how many securities are being redeemed, and as well as if the redemption is subject to any conditions precedent, which has to be satisfied. In terms of setting forth the redemption price, or what is the redemption price, the indenture will tell you. There is fixed price redemption, where it's simply just a percentage of the principal amount. Generally, it's set forth after the non-call period being about half the coupon, which reduces annually ratably over time until about 1 or 2 or sometimes 3 years out prior to maturity, where the redemption premium is nothing and you're redeeming them at par. Slide 13 here has language of a typical fixed redemption provision. Next slide, please. The other type of redemption is what is referred to as a make-whole redemption. A make-whole redemption is basically you take the present value of all remaining interest and principal payments on that security to either the maturity date or the date those securities are first able to be called by a fixed redemption. So you take the present value of all of those interest and principal payments, you take the present value of those and add those together. You determine that present value by using the applicable yield on the U.S. Treasury security that has the same maturity, the same term as the maturity date you're working with, or that earliest fixed redemption date. And to that yield, you add a what is a pricing term, generally anywhere between 30 and 50 basis points to determine that present value. So you take the present value of all those payments, you add those together, and the amount that exceeds the par amount of the bonds you're redeeming, that is the redemption premium. They call it a make-whole because, in theory, you're supposed to be able to take the proceeds from a make-whole, invest those proceeds into U.S. T-bills, and you would effectively be in the same spot. You are made whole as if you were never redeemed. Not sure if that is actually true in reality. Never tested it, but that is the theory behind it. So some debt securities have both. Generally, during what is referred to as the non-call period of first couple of years after issuance, you're able to redeem the securities by a make-whole. They still call it the non-call period because in those situations, that make-whole is so expensive that no one ever really takes advantage of it. And then after that non-call period, you would have redemption pursuant to a fixed redemption price. Next slide, please. Other considerations for redemptions, again, when you're doing it, make sure it's not prohibited by your other debt instruments. And if you're a public company, make sure to comply with Regulation D to make sure you're not having selective disclosure of material non-public information. The reason why this comes up is because if all you do is follow the indenture, then all you have to do under the indenture is issue the notice of redemption. You give it to the trustee sends it to DTC. DTC then forwards it on to the direct participants, and the ultimate beneficial holders of the securities may or may not be on the ball and get that information immediately, okay? But some investors in that case will, and some investors won't. And it may be material information to the issuer in general, but it probably most certainly is material to the holders of the securities that are being redeemed at that time. Okay, so in order to avoid selective disclosure, in addition to following the requirements of the indenture, you want to make sure you issue a press release announcing the redemption in its basic terms, as well as file a Form 8K with that press release. Next slide, please. Now we're going to talk about debt repurchases, and I'm going to turn it over to John Ablan.
Great. Thanks, John. As John said, I'm John Ablan. I'm a partner in our capital markets group here in Chicago. Going to be talking about debt repurchases as another form of liability management. So when we're talking about debt repurchases, what we're talking about here is an issuer or perhaps a financial intermediary on the issuer's behalf entering into the open market and effectuating debt repurchases, close to or around wherever the notes are trading. This can happen in a few ways, right? Sometimes an issuer can get a reverse inquiry from one of its existing bondholders, and with that person trying to see if the issuer is interested in purchasing the notes directly with them. Sometimes issuers will engage a financial intermediary to negotiate on their behalf and enter in the market and present them with limit orders or buy orders or whatever would have you. Sometimes a financial intermediary will have repurchased, will have itself repurchased debt and look to sell that to the issuer on spec. Next slide, please. The benefits of this are the ability to for an issuer to take advantage of a temporary, purchase price that is existing in the market, right? If the issuer's debt is trading below par, the issuer might want to take advantage of that and buy the debt, at 98, 97, or even lower, prices as a way to effectuate a deleveraging. It can be very efficient because debt repurchases require very little in times of preparation and documentation, and there are very low transaction costs. They are very effective when the issuer is only trying to repurchase a small percentage of its debt, or if its debt is not widely held. And the reason that that's true is that we want to avoid having to comply with the tender offer rules that the SEC has enacted pursuant to the Williams Act. So why don't we go to the next slide? So debt repurchases for small amounts of debt and on specific conditions can avoid the tender offer rules. But the key question is what constitutes a tender offer? And wouldn't it be nice if there was a definition of what constituted a tender offer under the Williams Act that Congress had created or that the SEC had promulgated? But there is no such definition. So without statutory or regulatory definition, it has been left to the courts, the federal courts, to interpret what constitutes a tender offer. The leading test that courts apply is something called the Wellman test, which comes from a case that was named after someone named Wellman, who I suppose was trying to avoid the tender offer rules. And they presented 8 factors. Factors are all listed here. I'm not going to read them all off to you, but the basic gist is that Congress, when they enacted the Williams Act, was trying to protect investors from sort of aggressive, manipulative, or practices that would put them under duress when tender offers were being conducted. They wanted to make sure investors had enough time to consider the information that an issuer was presenting to them and make an informed decision. So when the court was thinking about what constituted a tender offer, right, they said, look, when you're doing an active and widespread solicitation, when you're trying to buy a lot of debt, that starts to look like a tender offer, right? When you're trying to buy something at a premium, right? When you're trying to convince people to buy something at a premium to what it's being traded at, perhaps before another person could make the same offer, that starts to look like a tender offer. As opposed to buying just at the market price or whatever they're trading at. If the purchases are conditioned on each other, right? If you say, look, I'm not going to buy, all this debt unless everyone participates, right? And you're sort of creating a coercive environment and trying to get people to participate, that starts to look like a tender offer. So it's these 8 factors. No one factor is dispositive, right? So one, if you have one, that doesn't mean you're there. If you don't have one, it doesn't mean you're not. It's a facts and circumstances inquiry. So next slide. So the best, let's go to the next slide. The next slide, please. So the best, use of open market repurchases are for limited amounts of securities to a limited amount of holders. And, it's not required, but it's always better to have those holders be sophisticated to be able to fend for themselves without a lot of pressure and, preferably over an extended period of time. The prices should be privately and individually negotiated and sort of follow what the open market, price is of what the debt is. And with, each sort of transaction independent of another and not conditioned on some larger amount of debt being repurchased. Let's go to the next slide. Other considerations when we're talking about a debt repurchase, similar to a redemption, we have to make sure that our buying this debt is not prohibited under any of our other existing, debt instruments, and certainly under the indenture itself that you're trying to buy the notes back on. The other thing to consider is, look, you are in the market buying a security, right? As an issuer, you are buying back your own security. The U.S. anti-fraud rules, apply, right? And so an issuer can't purchase its own security on the basis of MNPI, right? If the issuer is in possession of MNPI, it either needs to refrain from trading or it needs to disclose that MNPI prior to engaging in the purchase. So that can be done if you know who you're buying it from, such as like in a reverse inquiry situation, that's very straightforward, right? If you're going into the open market, right, that's more difficult because you a lot of times don't even know who your counterparty is and you don't know what information you need to disclose to that person. If you are not going to make a public disclosure of whatever MNPI is, if you're only going to make the disclosure to the specific person that you're buying the security from, you need to think about Regulation FD, right? If you're a public company and you're making selective, disclosure of material, non-public information to your own security holders, that can trigger an obligation to make the same disclosure public unless you fall into an exception. The primary exception that you would use in a situation like this would be to get the recipients of that information to agree contractually to keep the information private and to refrain from trading before whatever the MNPI is ultimately made public. So different things to consider there. Obviously, the strategy will have to depend on the specific facts and circumstances. Next slide, please. Remmelt, I'll hand it over to you for tax considerations.
Great, thanks, John. So on the tax side, basically, I'll walk through if you repurchase at a discount or repurchase at a premium. For the issuer, and this is focused on a U.S. issuer, repurchase at a discount, the main consideration is COD income. So that's cancellation of indebtedness income, calculated as being equal to the adjusted issue price over the repurchase price. The issue with that is mainly dry income, right? So even though economically there is the loan proceeds have come into the issuer, typically the COD income event happens much later than that. So it's viewed as dry income. So that's something to be mindful of. Whereas on the other hand, if you've got a repurchase at a premium, then that premium might be deductible as interest to the issuer. And that amount is the excess that is paid over the adjusted issue price. For convertible bonds, Section 249, the deduction is only available for a reasonable premium. So basically what that means is, right, if the price of the convert has gone up, for example, as a result of underlying stock price having gone up, and then you repurchase, that premium would not be deductible for tax purposes. On the holder side, again, for U.S. holders subject to U.S. taxes, whether purchased at a discount or at a premium, the holder would have capital gain or capital loss, depending on the difference between the price the bonds are repurchased at and the holder's tax basis. And to the extent there is any gain, the market discount rules might turn some of that gain into ordinary income rather than capital gain. Then on the next slide, a couple of things to be mindful of in connection with COD income, which is if a related party repurchases debt of an issuer, that could still result in COD income to the issuer. That can happen if you've got, if there's an existing related party doing a repurchase of debt. It can also happen where a party buys a debt or holds the debt and then becomes related because the issuer ends up acquiring the equity. I think the test in the regulations is whether the purchase was in anticipation of becoming related. There's an exception for debt that is retired within a year. So within the 12 months, there's some more flexibility on that. And then there's a set of rules in the regulations that deals with, okay, now what happens if I've got deemed COD income as a result of a related party purchaser, then what happens? And so the regulations talk about a deemed issuance to the related holder of essentially a new instrument. I mean, new for tax. That can then create OID if it was purchased at a discount. So there's a few kind of COD and OID related rules to take into account when you've got a repurchase, especially in the context of a related party, both direct and indirect. That's the high level on the tax. And I'll note that we have a webinar on liability management that is all tax and kind of discusses the tax angle in more depth. But at a high level, that's the main considerations for repurchases. I think then I turn it back. Well, it's easy for me to say. I'm turning it back to John.
That's right. Thank you, Remmelt. Yeah. Okay, so talking now about tender offers, right? We talked about the ambiguous definition. The main drawback, if you'll recall, on debt repurchases was that we really couldn't be going out to a wide group of people, right? We had to keep it limited. We had to keep it with a small percentage. Sometimes that won't solve the issuer's problem, right? To, what won't, accomplish their objectives. So they'll have to go the full tilt and put out a full tender offer, right? What are the big advantages of doing a tender offer, right? Well, it's all of the things that were disadvantages in the debt repurchase, right? For a tender offer, you can go to any and all. You can go try to purchase the entire class of whatever securities you're trying to repurchase. Tender offer, you have a lot of flexibility in terms of how you price it, right? You don't have to follow the market, the open market, pricing, situation, right? You can come up with your own pricing structure. There are several different ones that are described here. You can do any and all, with, a specified price that's perhaps fixed or based on a fixed spread. We'll get to that in a moment. There's also the ability to do what's called a modified Dutch auction tender offer, where you give investors a possible range under which they can say, I will tender X amount of bonds and price it somewhere within that range. And then the issuer can select the price at which they will take down the transaction, right? They'll pay everyone the same price, but they can basically buy all of the bonds that were tendered in for the cheapest price first. It really depends on what your objective is, right? If you're trying to get most of the bonds back or close to all, you're going to be looking for an any and all tender, right? You're not going to be looking to create price tension. If you're only looking to get back a small portion of the bonds, right, now you're going to think, oh, well, maybe if I say to people, look, I'm only going to buy 10%, 15% of the issue, right? And, to get in, to make sure you're one of the people that I buy from, you have to put in with a low price. Maybe a Dutch auction is the better option for you. There's different, and then waterfall would be in between, where there's different, classes of debt that are selected, and, waterfall structures can be created where, debt will be repurchased higher up in the waterfall first, and you can price the waterfall accordingly. Next slide, please. So just mention this, obviously we can go out to everybody. Another benefit that you can, realize here is, instead of having to pay perhaps a very expensive make-whole redemption price that John Berkery was talking about, you can price this thing closer to somewhere between where it's trading at the market and between the make-whole, and still, accomplish a lot of deleveraging without having to pay the full make-whole price. Obviously, you can go to the entire investor base. You can combine it with a new issue, right? You can make the tender offer subject to a financing condition and say, look, I'm not going to do this unless I can raise, a certain amount of cash from a new issue, and condition it. You can also combine it with a consent solicitation, and John will talk more about that later on. Next slide, please. So all these benefits, there's going to be some strings attached, right? The SEC and Congress have created a set of rules that apply to tender offers. We're going to be focusing here on the rules that apply to tender offers for straight debt securities, with a note to say that if you are tendering for a convertible note, which is obviously convertible into some form of equity, that different rules will apply, and you should consult your favorite Mayer Brown attorney if you want to learn more about that. But for straight debt tender offers, we're really looking at Regulation 14E, and really rules 14E1, E2, and E3. And 14E1 is really the main rule, which requires that tender offers generally be held open for 20 business days and be held open for 10 business days following any increase or decrease in the amount of securities sought, the consideration offered, or any fee paid to a dealer manager, which is a financial intermediary who helps promote the deal and get people to tender in. Extensions must be announced by a press release, no sooner than the day after whatever the expiration was going to be. And so, that's really, the basic gist of 14E1. There's a few more rules, but one of the main benefits of, a tender offer structure for liability management is, especially for straight debt securities, this is true, that Regulation 14E does not require the filing of any tender offer documents with the SEC. That is not true in an equity tender offer, but that is true for a debt tender offer, which can make it more efficient and can be accomplished quite quickly, subject to the 20 business day requirement. Let's keep going. Next slide, please. So that's the basic rule 14E1 that I described. There is a library of various no action letters that the SEC has promulgated, in which various market participants have asked the SEC to give them relief from the strict requirements of the 20 business day rule and the 10-day extension rule. Prior to 2015, the SEC drew an important distinction between investment grade and non-investment grade debt, where the SEC was more flexible to allow investment grade debt to be, included in a tender offer, but not necessarily subject to the strict 20 and 10 business day rule under certain circumstances that we'll talk about in a minute. The other thing that the SEC permitted was, they sort of said, look, investment grade debt is often priced based on a spread to a treasury security, and that treasury security obviously is itself a publicly traded instrument that, has varying prices every day and intraday. And so setting a price, that was just a number or a percentage wasn't always practicable for an investment grade tender offer, because really the thing that people are trading on is a credit spread based on the risk-free rate of a treasury security. So the SEC has promulgated letters that allow investment grade debt to be priced based on a fixed spread that's announced either at the beginning of a tender offer or in some cases, during the course of a tender offer, and allow that to, even though the actual price is determined based on how the treasury is trading, that won't count as a change in the consideration offers, needing an extension of 10 days. Next slide, please. So, as I mentioned, in 2015, the SEC released a whammy of a new no action letter. We call it the abbreviated 5-day no action letter that John will talk about in future slides. But basically, it allows for any debt security, investment grade or high yield, to take advantage of an abbreviated tender offer process if certain conditions are met. But those conditions can be quite stringent, as John will talk about. And so to the extent that you are still dealing with an investment grade security, it's important to still understand, what no action relief is out there for the investment grade securities, as it is more forgiving than the 5-day abbreviated tender offer no action letter. Let's keep going. As I said, under the historical no action letters, investment grade debt can be, tender offers can be shorter than the 20 business day and 10 business day requirements if the offers to purchase are made to any and all, for any and all debt securities. We're open, to all, have to be open to all holders of the series, and are conducted in a manner, that's set up to allow all holders a reasonable opportunity to participate. They also, have to be sort of, there's sort of a calm waters, requirement, right? You can't be in the midst of competing tender offers for the same security, right? That's where the Williams Act is designed to protect investors and give them the amount of time to consider all offers. So there has to be there can't be, sort of big events in the corporate, situation that may be needed to be considered by various, investors. Next slide, please. So just to sum up, in the abbreviated no action letter rule, right? Investment grade debt can be, for tender offers that, remain open for much shorter amounts of time, sometimes even as short as 7 calendar days, although 10 calendar days is more common. The extension periods don't have to be the full 10 business days, but they still have to be, conducted with any and all people being able to participate. You're also able to use fixed spread pricing that I discussed earlier. Non-investment grade debt, on the other hand, absent relief from the abbreviated tender offer, still has to follow the 20 business day and 10 business day rules. You can use fixed spread pricing for a high yield offering if you set the spread 2 days prior to the expiration. Abbreviated tender offers, John Berkery.
All right, so the SEC's no action letter for abbreviated tender offers came out in January of 2015, and it was welcomed by the market for 2 reasons. It allowed issuers to conduct a tender offer, assuming it complied with certain conditions, for as little as 5 business days. The other positive element, as John was mentioning, is that it applied to any debt securities as long as they were non-convertible. As John mentioned, almost all of the previous no action letter relief related to investment grade debt securities, but the abbreviated tender offer rules applied to any debt securities, no matter how they're rated, as long as they're not convertible. Next slide, please. So in order to take advantage of the abbreviated tender offer rules, you have to meet certain conditions, which are set forth here on 35, and let's go through them. First, the tender offer must be an any and all tender offer, so no partial tender offers. The offer must be made by either the issuer, its wholly owned subsidiary, or the parent of the issuer, so no third-party tender offers. The consideration offered must consist solely of cash, qualified debt securities, or a combination of both. Okay, so what's qualified debt securities? They are essentially debt securities that are identical in all material respects to the debt securities that are the target of the tender offer, including who the obligors are, the collateral, the lien priority, the covenants, and other terms. The terms that can change are basically pricing related terms, such as maturity dates, interest payment dates, interest rates, the redemption premium, the non-call period. Those things can be different. The qualified debt securities also have to have interest payable in cash, so no PIK or pay-in-kind interest. And finally, the qualified debt securities must have a weighted average life to maturity that is longer than the targeted debt securities of the tender offer. Fourth, the tender offer cannot be financed with the proceeds of debt securities that are senior to the targeted debt securities. Okay, so say if your targeted debt securities are subordinated notes, the proceeds to fund the tender offer cannot come from a new issuance of senior debt. Similarly, if you have senior debt that is outstanding, that is unsecured and does not have the benefit of guarantees, that cannot be financed with the proceeds of a recent senior debt offering that is secured or does have the benefit of guarantees. Fifth, the tender offer must be made to all record and beneficial holders of the targeted debt securities, with one exception. If you are doing an exchange offer where you are offering qualified debt securities, and it is being done pursuant to an exemption from the registration requirements of the Securities Act, such that it is being made to qualified institutional buyers or QUIBs as defined by Rule 144A, or it is being made to non-US persons in accordance with Regulation S. You can do that and not offer the qualified debt securities to those individuals who are not QUIBs or not Reg S persons, as long as those people who don't meet those qualifications have the opportunity to participate and receive cash in lieu of the qualified debt securities in an amount equal to the approximate value of the qualified debt securities that were being offered to the QUIBs and the non-US persons. Sixth, the abbreviated tender offer must be announced no later than 10 a.m. Eastern time on the first business day of the 5 business day period. This is drastically different from how the first day is counted for your normal 20-day tender offer conducted in accordance with 14E, or your 7 to 10 business day conducted in accordance with for investment grade securities under the historical no action letters. In those instances, those historical instances, you could announce the tender offer any time of day, even 11:59 p.m. at night, and that would count as your first day. Not so with under the abbreviated tender offer rules. Has to be announced by 10 a.m. Eastern time, and if you are a reporting company, file that announcement on Form 8K. Finally, the abbreviated tender offer must permit tenders through guaranteed delivery procedures, must provide for withdrawal rights, and not include any early settlement feature. Next slide, please. Modifications: if there are any material changes to the terms of the abbreviated tender offer, it must be extended. In the case of changes to the consideration that is being offered, it must be open not less than 5 business days from the announcement of that change, and any other material change requires that the tender offer be open for not less than 3 business days from the announcement of that material change. And with respect to material changes, that must be announced by a widely disseminated press release, and if the issuer is a reporting company, that press release must be filed on 8K. Next slide, please. In addition to meeting certain conditions for abbreviated tender offer, there are also disqualifying events which you take you out of the box of being able to use the abbreviated tender offer procedures. They include the ones set forth here on slide 37. First, you can't have a concurrent consent solicitation going on with respect to the targeted debt securities. So no amendment to the terms of the securities you're seeking. The issuer cannot be in default not only under the targeted debt securities, but any of the issuer's other material agreements. The issuer cannot be in distress, meaning it can't be subject to bankruptcy or insolvency proceedings, have commenced an out-of-court restructuring, or otherwise commence some kind of prepackaged bankruptcy process. The abbreviated tender offer cannot be commenced in anticipation of or concurrently with any significant corporate event, such as a change of control, a merger or consolidation, a material acquisition or disposition, a competing tender offer, or any other significant restructuring of the issuer's capital structure. Next slide, please. A lot of material on this page. When in essence, what it's getting at is everyone likes the abbreviated tender offer rules that came into being in since 2015, but they're still not the only game in town. The market still relies upon regular 14E tender offers, the 20-day ones, as well as the no action letters for investment grade debt securities. And that is because it depends on what you're trying to achieve, or if it may need to be structured in such a way that you cannot take advantage of the abbreviated tender offer rules. For instance, say at the same time, not only delevering, but changing the covenant package is available to you. One of the disqualifying provisions, as I just mentioned, was you can't have a consent solicitation, or you can't be done in connection with amending the terms of the underlying targeted securities. So you'd have to go back to the old rules. Or if the dealer manager advising the issuer saying, look, the best way we can get the best pricing out of this transaction is to do an early tender premium with an early settlement. That's not permissible under the the abbreviated tender offer rules. So everyone likes the new abbreviated tender offer rules, but they're not used all the time. The other ones are still very much in play. Next slide, please. Exchange offers, back to you, John.
Thank you, John. All right, so we're running a little short on time, but I think we have time to go through this. So exchange offers. So if for whatever reason cash is not available to conduct a redemption, a repurchase, or a tender offer, or if there's certain favorable accounting treatment you want to get, which we'll talk about in a minute, exchange offers may be beneficial. Exchange offers may also be may be a useful tool if the company is looking to amend its debt securities in a manner that would otherwise require 100% consent, and which is unlikely to be obtained. And so sometimes companies will engage in an exchange offer with the terms that they wish their securities had, and obviously be able to get try and get as many people to exchange as they can. And change the terms of those fundamental terms of the securities without having to get 100% consent of the whole class. They just get 100% of the exchanging holders. So what are we talking about here with an exchange offer, right? An issuer says, instead of offering to pay cash, I will issue you a new security in exchange for your outstanding security. It can be more efficient, can be a potentially more efficient means to refinance or extend the term of your securities. It really depends on the market dynamic. But obviously, in addition to the other reasons that I just mentioned, right, the typical reasons to do it are if you're trying to do an extension of a maturity and you are a distressed credit, right? You don't have any cash to buy anything back, but you still need to extend the maturity on your debt. If you are trying to refinance the notes with a lower cost of funding, there can be various accounting benefits there. You're not paying two fees, right? You're not paying a new issue concession on the new issue and also paying a tender offer premium. If you are trying to change the obligor, right? If you're trying to exchange the securities in one corporate entity to issue and instead issue securities in a new corporate entity, an exchange offer can be beneficial. And again, there's some favorable accounting that we can talk about in the next slide, I think. Yeah, thank you. So this is a chart that basically compares two alternatives. On the left, we have an exchange offer, which is, as I said, just exchanging one bond for a new bond. On the right, we have instead an issuer doing a tender offer and a new bond offering, substantially simultaneously, right? So they're tendering for their old bond with the existing holders, and they're going out and trying to sell their new bond to new holders who may overlap with the existing holders, but needn't. And so that's really the yellow boxes on this really highlight where one strategy has an advantage over another. So the yellow box in the participation, basically is to say, look, when you're doing a tender offer plus a new issue, right, you can market the new issue bond to anybody, right? As long as you satisfy the securities offering conditions, right? If you're doing a 144A, you can issue it to any QUIB. You can issue it to any Reg S person, right? If you're doing a exchange offer, on the other hand, you are only talking to your existing holders, right? Those are the people, that's your entire set of people who can take the exchange offer. It's whoever holds the existing bonds. So it's a smaller universe, maybe gives them more leverage to negotiate back with you. Accounting treatment. So this is one of the big benefits of an exchange offer in certain circumstances, right? So if you satisfy certain accounting tests, the accounting treatment associated with an exchange offer may make the issuer eligible to have the premium that's paid over the existing book value of a security amortized over the life of the new security, right? As opposed to if you're paying a premium on the old bonds, right? That premium payment must be recognized in the period in which you buy the bonds, right? So it can be somewhat of a larger charge in a specific period, and sometimes issuers prefer to spread that charge out over the life of the new bond so that it has less of an impact on their results when they do the offering. New issue pricing is kind of the same thing as before, right? When you're talking to more people, you have the ability to, discover the price when you're marketing a new bond and do it based on a marketing, right? With an exchange offer, right? This is still a tender offer, and you are subject to the, potentially the 5, 10, or 20 business days rules associated with, changing the consideration offered. New execution risk. This is, we say that this one is better for the exchange offer, right? Because cash is required here, right? So you don't want to be committed to do the tender offer when you don't have the money and you won't have the money available, or it's contingent on needing a new financing, right? With an exchange offer, it's self-funding. There's no cash involved, maybe a small cash payment sometimes in different structures, but mostly it's self-effectuating. Next slide, please. Private exchange offers, right? As John mentioned, you have to either register, you are issuing a new security, right? So that issuance has to be registered or exempt. Most exchange offers, for existing debt securities, and certainly high yield debt securities, are done on a private basis. That doesn't require filing any documents with the SEC, and are done on a 4A2 basis. You have to avoid, as with any 4A2, doing a general solicitation. Usually the offering is limited to quibs, and usually there's a scoping letter, right? Where to participate in the deal, you have to, each holder has to sign a letter that says I'm a quib, or I'm a, non-US person offshore. Securities, one disadvantage of not registering with the transaction is that obviously the securities will be subject to transfer restrictions on the back end. In the past, this has been an issue, right, where investors may ask for registration rights. With the proliferation of Rule 144A and the robust market that's been created as a result of that, that's less common. Let's go to the next slide, please. So the other exemption we can use is 3A9, right? And 3A9 has some big advantages, but some very big disadvantages, I would say. So it exempts from the registration requirements any securities exchanged by the issuer with its existing security holders exclusively, where no commission or remuneration is paid for soliciting the exchange. Section 3A9 has 5 requirements, right? The securities have to be at the same issuer, right? There is some no action relief for changing out guarantees and moving things from parent to wholly owned parent to wholly owned sub, but generally that no action letter is very, that relief is going to be limited. So really we're looking to stay at the same issuer. There can be no additional consideration from holders, right? This has to be a security for security exchange. There can be, so we're not asking the security holders to pay us any cash in connection with the exchange. This is, just security for security. If we're raising capital to get cash, that's not going to work. Let's go to the next slide, please. The exchange offer has to be offered exclusively to, the issuer's existing security holders. That sounds simple, but you got to be careful to avoid integration if there are any other offerings going on. The issuer can't pay any commission or to a dealer manager or to a financial intermediary. This is really a big disadvantage, right? Because if you can't have a dealer manager helping you promote the deal, it can be sometimes very difficult to get folks to tender in. And so, if you're doing a 3A9, the dealer and you still want to have a financial intermediary involved, their activities are going to be very limited to very ministerial or mechanical, sorts of things that basically kind of make this, a very difficult exemption to use if you want a dealer manager. The last exception is it has to be made in good faith and not as a means to avoid registration. Next slide, please. So some things to think about with 3A9 exchanges. Obviously, like if the securities were restricted securities to begin with, the new securities you're issuing will be restricted securities also. You have to avoid integration with other securities offerings. And if you are not if the indenture is not already qualified under the Trust Indenture Act, you will have to do so, right? That securities issued in the 3A9 will not benefit from the exemption from the Trust Indenture Act requirements. So you want to make sure your indenture qualifies, and that will require a filing with the SEC. Next slide, please. I think this is tax. Yes, Remmelt, back to you for taxes.
Yep, that's right. So I think the main thing here, the main message on the tax side is that the same rules, the first bullet, the same rules apply to a debt for debt exchange as an amendment of terms. So the tax law essentially looks to, is there a significant modification? So it can be a modification of an existing instrument that stays outstanding, or it can be an exchange of an old note or an old debt instrument for a new debt instrument. So even though there's an actual exchange for tax, that could be the continuation of an existing instrument if it's not a significant modification. So we look to significant modification. It's there if the legal rights or obligations that are altered and the degree to which they're altered are economically significant. It's kind of like the general rule. There's one test, what we call the yield test, that if the yield changes by the greater of 25 basis points and 5% of the existing yield, you've got a significant modification. So that's kind of an on-off switch on yield. Then for maturity or payment deferrals, it kind of works the other way around. It's a significant modification if there's a material deferring of payments, but then there's a safe harbor. It says if the deferral is equal to the lesser of 5 years or 50% original term, then you don't have a significant modification. So it basically comes down to carefully reading the regulations and some of the authorities to determine whether or not there's a significant modification and therefore a potential tax exchange. So then on the next slide, I'll just mention briefly, once you have a tax exchange, one question is, are the instruments publicly traded or not? And that's a tax test. It's not the same as being listed and traded necessarily. In other words, like broker quotes and there being a market in the securities might be enough. And whether or not it's publicly traded then determines kind of how you determine the amount realized and the issue price of the new instrument. And then similar to what we talked about on the tax side for repurchases, we would look to, between the issuer and the holder, you look to, is there COD income? Does the new instrument have OID? Is there gain or loss to a holder? And a large part of that is it what we call a recapitalization for tax purposes, which depends on whether the notes are securities. And there's no black or white rule on what are securities for tax purposes. Generally, less than 5% no. Less than 5-year term no, more than a 10-year term yes. In between a bit of a gray area. And with that, I'll turn it back to John for consent solicitations.
Okay, consent solicitations. We are right at the 3 o'clock hour. I will try to make this very short. All right, so consent solicitations obviously is soliciting consents from the holders of the debt securities to amend the terms of those debt securities. It is one of the liability management transactions, unlike tender offers, exchange offers, and repurchases, where there's really no SEC rules or no action letters to comply with. It is strictly contractual. And so you look at the contract, the indenture or other debt instrument that governs the debt securities to see what consent is needed for the amendment that you want to effect. Most amendments require a majority of the outstanding debt securities. Some require a supermajority, like 66% or 75%. Those are generally when you're releasing collateral or releasing guarantees. And then finally, Some amendments require 100%. Some indentures allow 90% consent for things like reducing the principal amount, reducing the interest rate, extending the maturity, or changing the redemption premium. Though it requires that higher level, 90 to 100%. Now, in order to incentivize holders to consent, you have to give them generally a consent fee, which is the carrot. But the consent fee will not be set forth in the indenture. It is very subjective. It is determined by the issuer with the advice of its dealer manager who is working on the transaction with them. And in the blue circle here are a number of the conditions that come into play when you're trying to determine the consent fee. The most important of which is the materiality of the amendment that you're seeking. The more material, the more it's going to change the security, especially when it's in favor of the issuer, could impact the security's marketability, requiring a higher consent fee. But again, the consent fee is very subjective, okay? So in order to get a handle on that and not fall on their face when they launch the consent solicitation and have no one consent, they try to get a reading. So the issuer generally goes out to a handful of very large holders and talks to them, says, this is the type of amendment we want to effect. This is the consent fee we were thinking about offering. What do you think? And they go back and forth and they negotiate and they come to a resolution, at which point the holders they were talking to sign an agreement, which says, if you launch a consent solicitation based on these terms, I agree to give my consent with respect to all of the notes I own in your consent solicitation. Then the issuer turns around, he launches the consent solicitation, and in the statement describes the amendment that in the consent they're seeking. The statement says right on the cover, hey, holders, we already have the agreement from holders holding blank percent. It's generally a pretty significant percentage, like 30%, 40%, sometimes even higher. We have the agreement by holders who own 30 to 40% of the outstanding notes who have already told us they're going to tender their consent in this solicitation. What does that say to the other holders? Wow, they're almost there. I better get on board, give my consent, because the amendments are going to come regardless. I might as well get my consent fee. So that's how usually it is structured. Next slide, please. What are the benefits of a consent solicitation? Won't go into depth on it. Very easy. You get covenant flexibility. You potentially avoid a default. You're able to do a transaction you otherwise couldn't, or otherwise gain operational or financial flexibility. Next slide, please. Next slide, please. So for consent solicitations, I talked about the carrot before, the consent fee. Sometimes you need a stick. And the way a stick is implemented in a consent solicitation is by using exit consents, where you marry a consent solicitation with a tender offer or an exchange offer. And it works like this. You go out to holders, you're asking them to tender their securities for cash or tender their securities in an exchange offer for new debt securities, which has a covenant package the issuer can live with and thinks it would be at least palatable also to holders, okay? In addition to that, it says, if you tender your securities in the tender or exchange offer, by doing so, you will automatically be consenting to amendments to the existing indenture, which will strip out all of the covenants in that indenture. And so if you do not participate in the exchange offer or tender offer, you will be, and the amendment does go effective because they got the requisite consent from the other holders who did participate. You will be holding a debt security with absolutely no covenant protection. And so if you're fearful that there's a good chance that this amendment will go into effect and that enough people are tendering, you might as well tender and at least an exchange offer, get the securities with a revised covenant package. Otherwise, you'll be holding a security with no covenant protection whatsoever. Next slide, please. Can I hand it over to you, Remmelt?
Yeah, so I mean, very briefly on the tax side, I think the main message really is that the treatment of consent fees is unclear. There's a private letter ruling from a little while ago that unfortunately didn't shed a whole lot of light on it. So beware of consent fees and make sure you get some tax advice. And then I think that is it. Feel free to reach out to one of us with any questions.
Thank you.